And I'm sure if you have a question about something, there's probably 10 other people that have the same question. So try not to laugh if you think it's a dumb question, because everybody had that question at some point when they were learning about blockchain. And the last thing is, I talk relatively fast. I'm trying really hard to slow down. But that means if you check your phone or your laptop, you might lose like the train of thought or where I am. I'm not your mom. I'm not going to tell you to put your laptops or phones away, but you probably won't be able to keep up if you do. So I promise not all my slides have this much crap on them, but this is just like a quick overview of what we're going to talk about tonight. We're going to start with the two core technical issues with existing monetary systems and the solutions that we already have with our established fiat system. And then I'm going to go into Bitcoin's solution, including what a blockchain is, what Bitcoin is, how you create a transaction on the Bitcoin network, where mining comes in, and the 4 separate stages of mining, including verifying transactions, hashing, proof of work, block reward. I mean, I'm pretty sure you all know how to read. And then I'm going to go on to currency issuance and regulation/consensus issues in blockchain and Bitcoin. And then at the end, as I said, questions and clarification. I'm more than happy to go over something again. And there's also other people that are really smart, probably smarter than me in the audience, that might be able to explain things better if you didn't get it the way that I explained it. So let's first talk about 2 core technical issues with the existing monetary system, or any monetary system really. The first one is known as the double spend issue. If I have a bank account with $100 in it, how do we ensure that I don't spend that money twice? That I don't send Will a $100 check and Popa a $100 check both at the same time. So the current way that we deal with that is we have banks that keep track of our balances, these private power centers that control the ledger being all the transactions that have occurred at the bank. And they go through what we call clearing houses to verify that everybody has the right amount of money. The issue with this is it's really hard to become a bank, and it's really hard to become part of a clearinghouse institution, which means there's a very high cost to entry, which means there aren't that many banks, and the power is centralized within them. It also means that the government can very easily regulate the currency because there's only like a few key players that they have to really step down on to enforce their will. The next core issue with monetary systems is issuance and regulation. So by that I mean, what's it backed by? How much gets released every year? What are the rules that everybody has to play by? And I think if you have money, you should want to know these things. You should want to know for sure that somebody can't just make 10 billion more dollars tomorrow just because they feel like it. And with the current state of things, the Federal Reserve could technically do that. So that's a quick high-level overview of the 2 issues and how we deal with them currently. Now I'm going to kind of go into blockchain and Bitcoin's solution to these same problems. So I guess first we should talk about what is a blockchain. I said before that banks have a ledger of all the transactions and everybody's account balance. In blockchain, every single person, every single node on the network has a copy of the same ledger. That is, everybody has a distributed, replicated database. Everyone has the same data. So everyone knows how much every other person has. You probably heard that Bitcoin's anonymous. It sort of is, in that your name isn't attached to the value that you have, but your account number is attached to the money that you have. So as long as you can separate your name from the account number, it's anonymous, but as soon as your name gets tied to an account number, you're completely traceable through the entire blockchain. The cool thing about this is it's decentralized. It's not just one bank, it's thousands of nodes distributed across the entire world, and regulation of that's incredibly hard. You've got to have international cooperation between governments, and even if they all come together and say we don't want blockchain anymore, they really can't stop it, just like torrents. The music industry doesn't like torrents, the video industry doesn't like them, but they still exist. There's no real way that they can stop them. So that's what blockchain is. And for the first kind of half of talking about blockchain and mining, I'm going to be really addressing the double spend issue. How transactions get verified, sent through the system, and make sure that they're only spent once and not spent multiple times. And then at the end, I'll go into the issuance and regulation side of things. So you have this distributed network, and you want to send a transaction. I want to send Will $100 worth of Bitcoin. Let's not worry about how I got the Bitcoin for now, because I'll get into that later. But let's just assume that I already have it. So through a wallet application, either on my phone or on my desktop, I can create a transaction that essentially has 4 parts. The sender's address, that's my address, my account number, the recipient's account number, an amount of money that I want to send, and a signature. Once I put all four of those things together, I send them off to the network, and it's put in a backlog of transactions that's referred to as the mempool, the memory pool of the network. And this is where the mining process sort of starts. There's 4 parts to the mining process. Depending on how you define it, I've just split them into 4, so it's a bit easier to understand. The first part of the mining process is verifying the transactions that come in, the transaction that I sent. So they'll look at the transaction for $100 worth of Bitcoin, and they'll go through the entire history of the blockchain to make sure that I have that much money in my account. They'll also check that the signature on that transaction is valid. And it kind of goes outside the scope of this talk, but it falls into this category called public-private key cryptography. It's something that was invented 50 years ago by GCHQ. It's like the NSA of the UK. And in the past 50 years, nobody's been able to break it or find a flaw with it. So you can be reasonably certain or almost completely certain that if something's signed by your private key, it was only you that signed it. So once the transaction has been verified that it's actually from me and that I actually have the money to do it, we then go into this topic called hashing. So in the transactions that were taken from the backlog, from the memory pool, it wasn't just my transaction that was picked up. It was thousands of transactions that were all picked up at the same time. And each of those transactions has to be hashed. So what is hashing and what is a hash? Simply, hashing is a way that you can take any input and convert it into a common output format, and that output format is usually a number. And a very easy way to explain this is by a naive algorithm that does it through turning a word into a number. If we look at the word block, B-L-O-C-K, B is the second letter of the alphabet, so we give it a value of 2. L is the 12th letter, we give it 12, and so on and so forth. We add all the letters together, we get 43, which represents the word block. 43 in our algorithm is the hash of block. So in Bitcoin, we want something a little bit better than that. We want a one-way hash. And a one-way hash has 2 criteria. One is that you cannot get the input from the output. If I show you the output of the hash, you do not know what the input was. And the second thing is we have to minimize what we call collisions. If you look at the block example and the number 43, there's probably a bunch of words that all, if you add the letters together, would come up with 43. That in hashing is known as a collision, 2 inputs that equal the same output. The hashing algorithm that Bitcoin uses is called SHA-256. Again, I can go into the technical side of things towards the end of the talk if anybody's more interested. But for now, just know that you can have a hashing algorithm, that you cannot get the input from the output, and doesn't have any collisions. In SHA-256's history, there's not been a single collision found, although it is technically possible. So why did I talk so much about hashing and these transactions? And I'm just going to show you on the whiteboard what I mean when I say Merkle tree. So Merkle tree is a hash tree. We call it Merkle tree because some guy called Merkle invented it. And what that is, if we assume there aren't thousands of transactions, there's just 3 or 4 rather. What we do is we calculate the hash of each of these transactions. Let's just make up some random numbers that they hash into. In reality, these probably would be like quadrillion, like in the realm of quadrillions or even bigger numbers than that. And in a Merkle tree, what we do, because we know that our algorithm doesn't have any collisions, if we hash this number, we can hash our hash and come up with a further number. And what we can also do is add these numbers together. I don't know what that adds up to. I'm just going to make it up. So we add these numbers together and get this, and then we hash this to get a further number. And then we add these 2 numbers together again, and we hash this, and eventually we get to what we call a root hash. So from these 4 initial inputs, we generate one hash that represents all of the transactions that are in the block that we're currently mining. An important thing to note about Merkle trees too is I only showed you 4, and there's 3 steps to get to the Merkle root. But if we increase the number to 8, there's only going to be 4 steps, because at this step you have 4, then 2, then 1. If it's 8, then it'll just be 8, then 4, then 2, then 1. So it's what we call logarithmically scalable in computing. So at this stage, we have our root hash. And this is where proof of work comes in, the third stage of the mining process. We have our Merkle root, and what a miner is trying to do is find what number they can add to that Merkle root, which when combined and hashed again, results in a final number that's small enough to meet a certain criteria. So what I mean by that is, if this is the range of all possible hashes that you could get, and it's completely random which one you get every time you hash, we want to make it so that our final hash falls in this tiny little range. So it's like 1 in quadrillion chance of being able to find it randomly. And the only way to find that hash is to brute force it. So if we say that our final Merkle root is 52, we add 1 to it to get 53. We then hash that to get another number. And what we're trying to get is this number small enough. Currently in Bitcoin, by small enough, we mean a number that starts with 18 zeros. So if we assume that the number is 52 digits long, we want it to start with 18 zeros, for example. So after brute forcing and trying to find this magic number, they might find that magic number is 562 billion and so many millions and thousands and hundreds or whatever. Even though it took hundreds of millions of attempts, hundreds of millions of hashes for me to find that magic number, if I then send that out to the network, you can very quickly verify that it's the right number. Because all you have to do is get this root hash, which is relatively easy to get computationally speaking, add the magic number that I broadcast, 523 million something something, you get the result, and then you verify that it's small enough. So even though it took me 500 million attempts to find the number, it only takes you 1 attempt to verify it. In blockchain, we want a block to be mined that is a magic number to be found about every 10 minutes. And the way that that is kind of mediated by the power of the network is the more power that's in the network, the smaller the target is of the final hash that you can calculate. And that's what we refer to as a difficulty adjustment. So it's an awful lot of work for a miner. He has to do hundreds of millions, if not trillions, quadrillions of calculations to try and find that magic number. What do they get out of it? So at present, whenever you successfully mine a block and it gets verified by the network, you get 12.5 Bitcoin. And I calculated what that was this morning, but then it went up by like $400, so I'm not entirely sure. I think it's like $65,000 worth of Bitcoin, somewhere around there, is the block reward that you get. And I also left something out when I told you that we create a transaction with 4 things. There's the sender, the recipient, the amount, and the signature, but there's also a transaction fee that you're willing to pay to get your transaction into the next block. And it kind of becomes this transaction fee market that people that are willing to pay the most to get their block included, to get their transaction included, will get that transaction included before other ones, should the network be slow or overloaded. So at present, the transaction fee on average works out to about 1 Bitcoin. You individually won't pay that because that's split across the thousands of people that are in one block. You'll probably pay like $1. And on some other chains like Bitcoin Cash, you pay less than 1 penny. So that's sort of how mining works. That's how you send a transaction in the network. Once that block gets mined, it gets added to all the previous blocks in a chain. That's why we refer to it as a blockchain. And a block is just a group of transactions. So currently, you get 12.5 Bitcoin for every block that you mine. When Bitcoin first started, the first block was mined on January the 3rd of 2009, so almost 9 years ago now. And Satoshi Nakamoto, the person that mined the first block, got 50 Bitcoin. Over time, the block reward goes down. And in the year 2140, the block reward will be 0, and miners will be entirely paid by transaction fees. In 2140, there will be 21 million Bitcoin in existence. And because we kind of have the amount of Bitcoin that we issue every few years, we have the block reward. That means that currently there's 16.7 million Bitcoin in existence, which is 80% of the Bitcoin that will ever exist. And this is why we call Bitcoin deflationary, because there's less and less released every year until at some point no more will be released. I'm going to briefly talk about regulation, but it's kind of a topic of its own. It's super complicated. How do I prevent somebody saying, I want there to be 42 million Bitcoin now, or I want there to be a bigger reward in the blockchain. Well, in order for that to happen, you'd have to get what we call consensus or agreement from all the different parties in the system. That's miners, the people that actually mine the blocks, wallet providers, where I actually create the transaction, exchanges that list the coins, so you can trade them for other coins or for US dollars or for whatever, merchants that accept Bitcoin for their products, developers who actually code the change to the system, node operators, which are like miners, except they don't look for the magic number. They just verify that the magic number is correct and that the transaction is valid. And then at the end of the day, the end user that's actually going to use the Bitcoin to transact with. Because if we decide that we don't like the change that they're making to the system, we can just sell all of our Bitcoin for another currency, another altcoin, another cryptocurrency, or even back to fiat. And then the currency has no value. So we have to get consensus among all these parties to successfully move a chain and keep it all as one single blockchain. If we get a significant minority that want to go off in a new direction and they can't come to some sort of agreement, we have what we refer to as a fork or a chain split. And this happened recently with Bitcoin Cash and Bitcoin. Bitcoin Cash decided that they wanted to have the amount of transactions in a block be bigger. So currently the block size for Bitcoin is 1 megabyte. They wanted it to be 8 megabytes because they said the blocks were filling up too fast. So they split off and went their own way. And the way that it worked was if you owned Bitcoin before the fork, say you owned 5 Bitcoin, after the fork, if you had 5 Bitcoin at the beginning, you'd own 5 Bitcoin Cash and 5 Bitcoin. You don't lose any of your money, it just gets split between 2 chains. And with Bitcoin Cash, it ended up working out quite nicely for a lot of people that own Bitcoin because Bitcoin Cash's price at the split was about $400. Bitcoin's price was about $4,000. So everyone essentially got a free 10% dividend if they just sold the Bitcoin Cash right away for Bitcoin. It could go horribly wrong, but it's not happened yet. We'll see what happens in the future. That kind of wraps up everything that I wanted to talk about from a technical standpoint. I do have a blog if you want to check it out. I talk about stuff like how to track your net worth in cryptocurrencies and how you can buy Bitcoin in a step-by-step guide. It's completely unmonetized. I don't have any affiliate links or anything. It's purely educational. And I'm also semi-active on Twitter, and my Twitter handle is jsterling8. So now I'll kind of open up the floor for any questions that people have. And if you feel like you have a good answer to that question, just feel free to raise your hand and answer it for me.
Wait, sorry. Oh. Test.
I don't know. Like, I'm not really an investment advisor, and I really hesitate to give people advice. And anytime you talk to somebody in cryptocurrency and they're telling you about a new coin, they always end it with, but I don't know though, just in case they ruin your life. So I'm a big fan of Bitcoin. I'm not a big fan of Ripple. I'm not a big fan of Ethereum. I've got personal reasons for it, but people probably have equally good counter arguments, and you kind of just have to look into it and make your own decision. Yeah, so there are price apps that you can get on your phone that will send you an alert if the price swings by a certain percentage that you put in. The thing that I always recommend to people that want to buy crypto is I just say, if you believe in the technology, if you've really looked into it and you think that it's good, put a certain amount of money in it and forget that it exists after you secured it. Forget about it for 2 years and come back and check. Because all that happens with the market, it's super volatile right now. The price will tank, you'll panic, you'll sell, you'll lose your money, and then the price will recover and you'll think, fuck, why did I sell all my Bitcoin? Yeah, so there's like, is it Grayscale? Or? Yeah, there's like index funds of Bitcoin, or of cryptocurrencies, which is essentially it picks the top 20 that they believe in and splits their money evenly between them. And you can kind of invest in that index fund rather than picking the currencies yourself. I think there's definitely potential for it, but then whenever I start to go in this realm, like I'm a developer, like I understand the technology. When you start to talk about things like that, you go into economics, politics, all things that I really have no idea about. And that's kind of one of the cool things about cryptocurrencies is there's so many different aspects of our daily life that it touches that kind of everyone can kind of get involved in a way. So I really don't know. I mean, I hope so. I think it's better than what we have currently, but I'm unsure what will happen in the future. There's a guy called Andreas Antonopoulos that talks about a bunch of stuff like that. Antonopoulos. I don't know how to spell it. Google this though.
So right now, buying cryptocurrency still kind of feels a lot like buying stock because I don't see a lot of application yet personally. You're a developer, so you might have some. Like, what do you use it for? That might be a bit.
I use it as an investment vehicle, and I also do it in my day-to-day work. I do I do algorithmic trading of cryptocurrencies, but of other people's cryptocurrencies, not mine. I just hold mine. I guess it depends how you look at it. I don't use it on a day-to-day basis. I just buy it and hold it. And my girlfriend actually has explicit instructions that she's allowed to pepper spray me if I try and sell it on an exchange in the next 2 years. Yeah. Somebody else had a? Yeah, so
Jonathan, if you can repeat like half the question so online community can
my
understand this.
bad.
Yeah.
So the question was, do there exist significant inefficiencies in the market that you can take advantage of by arbitraging them? For those that don't know, arbitraging is where you at the same time buy in one place and sell in another so that you're guaranteed a profit of a certain amount of money because the price here might be lower and the price here might be higher. So if you buy here and sell here at the exact same time, you can make 1% on your money. There's definitely still opportunities for it. I think in the next few months, the market will become a lot more stable and those arbitrage opportunities will kind of be weeded out as more volume hits the markets. They still exist, but a lot of places have like a 0.25% transaction fee for doing the exchange on the exchange. And then you've got to times that by 2 because if you're arbing, you're doing it in 2 places at once. So you've automatically got a 0.5% loss. So the ARB has to be of a significant size. There was recently like ARB opportunities with the Korean won. So the Korean won for Bitcoin was trading at a huge premium because of remittance issues in Korea. That is, they couldn't get the money out of their country. They're only allowed to take $50,000 out of their country every year or something. So people were trying to buy Bitcoin so they could send the Bitcoin out, convert that to US dollars and send it to their family or whatever. So the Korean won was trading at like upwards of like a 10% premium. And now Korea is like really cracked down on regulation and the price is tanked. So now the price in Korean won is actually less. So if before you had kind of done a long-term arbitrage, like you bought because, you'd sold because you had a bunch of Bitcoin, you know you could get more money for it, and then you held a Korean won position, you could now buy back in more Bitcoin than you had initially. So the question was, if everything's traceable, how do hackers get their money out into fiat when to be on an exchange, they have to reveal their identity. So then that ties the account number that, for example, a ransomware virus would tie that address to an individual and they could get prosecuted. A lot of law enforcement officials view blockchain as like this honeypot of all these people they can arrest in like 10 years when they finally figure out how it all works and how to like navigate through who owns what. There are ways of laundering money. There's currencies that are completely anonymous, like Zcash, where you can transfer it in and then take it out somewhere else, or you can use a scrambler. I'm not sure if that's the exact correct term, where everybody puts their money into a big pot, a bunch of transactions are made, and then it comes out on the other side with a different amount, minus some fee. So there's like ways around it, but I wouldn't want to get any more technical than that and advise people on how to launder money. So the question was, I said before, there's now Bitcoin and Bitcoin Cash. How does that work? Are they the same thing? What is a fork? So what happened was there was a disagreement with the implementation of Bitcoin about how it would fundamentally work. One of the fundamental variables in Bitcoin is how many transactions you can put in a single block. Bitcoin Core, like the core team that works on the main Bitcoin, what we know as Bitcoin today, were of the opinion that they should use some new technology called segregated witness in order to be able to fit more transactions within the same block without expanding the block size. Bitcoin Cash's side was the limit of 1 megabyte has always been intended to be removed. It says in the comments of the code, this is like an arbitrary limit to prevent spam. If we ever reach this limit, you can increase it. I think the argument's really nuanced because if you increase the block size, there's a bunch of run-on effects from that to do with scalability and decentralization. I don't think either side is right. I think they're both wrong, and I think they're both assholes. But what ended up happening was you had this fork called blockchain. Some miners decided we're going to mine with the Bitcoin Cash protocol, that is 8 megabyte blocks. And other people said we're going to keep mining on the original chain. So then when that happened, Bitcoin Cash started mining blocks that were bigger than 1 megabyte. And the original network started rejecting those blocks because they didn't meet the requirements of what is Bitcoin. Because one of the things that's checked, other than the signatures and the hashes and all of that, is the block size correct? So that led to a fork in the chain, which meant that some miners continued to mine the original Bitcoin and others kept mining Bitcoin Cash. And they blacklisted each other, so they weren't sending each other any blocks anymore. It is to, it's more of a philosophical question. It's listed on exchanges as 2 separate currencies. Yeah, so if you had 5 Bitcoin at the fork, you then had 5 Bitcoin still and 5 Bitcoin Cash. And you could sell your Bitcoin Cash, you could sell your Bitcoin, whatever. Oh, so you're saying since they're both rejecting each other, how do you? Yeah, they're effectively 2 separate chains now that have a common root chain that split on August 1st or somewhere around there. What was your third question? So lowest is like just an easy way to restrict the range of like numbers that you need. Like if there are 10 quadrillion possible hashes, you're just saying that the final hash you come up with has to be in this subset of hashes. And a very easy way to do that is it has to be in hash 0 to a million. And if there's a quadrillion possible hashes and you can only get in the range of 1 million, your chances of randomly coming across that hash are whatever a quadrillion divided by a million is. Does that make, okay. Who pays the Bitcoin Core developers? So there's 2 developers on Bitcoin Core that are paid by a company called Blockstream. There's 1 or 2 that are paid by a company called Chaincode Labs or something like that. And there's some people that just do it for free. It's a very interesting question, and I'm going to talk about that next week in my talk called Why You Shouldn't Buy Bitcoin. Because I'm controversial. Yeah, should not. Yeah, I'm kind of a hypocrite. Like more than half of my net worth is in cryptocurrencies, specifically Bitcoin. But I still don't think you should buy. Anybody else? Yes, my business is super interesting. No, there's a bunch of interesting stuff happening. There's all these ICOs in the space. 99% of them I think are just scams and nobody will make any money. But there's a lot of people trying to see what they can do with blockchain technology. And I don't think it's at a point now where you'll actually really see anything like usable and viable. But I think in the next 5 to 10 years, you'll start to see like a bunch of stuff coming out. So there's a lot of opportunity in the space. And I work specifically like with fintech companies doing foreign exchange. So I provide a route for like traditional foreign exchange companies to purchase cryptocurrencies. And then I market make for them. And market making for people that don't know is if this is a Bitcoin and we say this Bitcoin is worth $100, I'm always buying Bitcoin at $99 and I'm selling it at $101. And that has what we call a 2% spread, the spread between what I'll buy for and what I'll sell for. So I work with these foreign exchange companies and market make with them. And then when they buy from me, I arbitrage that off on an exchange because the spot price that we provide them is like from an amalgamation of exchanges. But when I buy on an exchange effectively on their behalf, I buy at a lower rate than the spot. So I get the spread that I give them, then I also get the percentage arbitrage opportunity. And that's a lot of big words. Yes. Yeah, effectively. But the reason that it's hard for traditional finance to get into blockchain is all the regulations that they're currently a part of. If a traditional firm wants to like buy a bunch of crypto, they generally meet a lot of resistance from their bank and from regulators. So the way that we do it is we're all like financially accredited because my co-founders were all like heads at, what's that company called? That investment one that trades oil? Not Morgan Stanley, is it? JP Morgan, something like that. I don't know. And then, so he has all these connections in the industry. He knows all the CEOs of this company, and he knows how to get all the paperwork through so that we're accredited and they can trade with us. So we can trade them Bitcoin. And we're kind of like one of the few entry points for traditional finance, which is why we have such a good opportunity right now. But I think like that'll open up loads in the next 6 months, and I think the price of Bitcoin might explode, but it might not. The question was, is a government able to track down transactions now? Sort of. So there was like the BTCE thing recently, which was an exchange, and some guy got like accused of laundering money, and they connected his accounts together. And I mean, it's possible, and I think you'll see it start to happen more and more often. And I think you'll start to see like people that did it like 2 years ago get arrested now because the law's kind of finally caught up with it. So it's definitely possible. Anybody else? Why am I bearish on Ethereum? Because oh God. I think the programming language that they use is shit. I think there's a bunch of problems with the way that they implemented things. There's a big like Hacker News post as to why, like if you were to invent your own language, why you shouldn't do the things Solidity did. I think they have a central point of failure in Vitalik, the guy that created Ethereum. It kind of becomes, we do whatever Vitalik says. And kind of leading on for that, there was this event called the DAO, which was this ICO essentially, where somebody made a smart contract that said, if you pay money into this, you get a certain amount of our cryptocurrency in exchange. Somebody found a flaw in that contract and was able to get like $100 million worth of Ethereum to themselves. And what Ethereum did at that point, because Vitalik told them to, was everybody stop everything. We're going to roll back the chain to a previous block. Too bad if you spent your money. A bunch of my friends lost millions of dollars, so I'm going to roll back the chain for them. And I think like ethically, that's completely against what blockchain is. It should be immutable. So I think Ethereum Classic is the true Ethereum. And I think Ethereum is, I don't know, should be called something else. I lost a lot of money on Neo. I don't know. Neo is like, I'm gonna like way oversimplify this. It's like the Ethereum of China. Do you want to explain what a Neo is? I'm going to talk about like a lot of this stuff, like why crypto has value and how like the price is so volatile and how there's like market manipulation and how do you value something that's backed by nothing all next week. Yeah. Yeah. I really don't. So the question was, should we focus on the big names or should we diversify our portfolios and invest in a bunch of things? I don't know. Like I have no real experience with like investment. I'm purely in it for the technology and I like it, so I put money into it.
So on that note, then, do you put your gold in what Bitcoin, Ethereum, and Litecoin, for example, have that could be filled by other cryptocurrencies, like or other ones to get?
so the question was, are there holes or flaws in the implementation of Bitcoin and Ethereum that kind of paves the way for a competitor to come through and get a bigger share of the overall market cap of crypto? Yeah, absolutely. I think there are huge issues with the main two issues with Bitcoin are centralization and scalability. And I'm going to talk about all those things next week. I feel like I'm really trying to sell my talk next week. So yeah, like for example, one of the issues is the hashing algorithm, which we talked about here, to find that magic number, SHA-256. So it used to be like one CPU, one vote. So everyone had kind of like an equal chance of being able to mine a block. And then people discovered if they mined with their graphics cards, that was much better at computing SHA-256 hashes. And then people discovered that they could make these custom-made chips that were specifically made for like calculating SHA-256 hashes. And these chips are super expensive. And in China, they have like exclusive access to a lot of the supply. And they set up these factories with all these chips in them. They're called ASICs. It stands for Application-Specific Integrated Circuit. They set up these factories with all these ASICs, and they're located right next to like a dam that's just been built. And because the government built the dam there right next to like all these businesses, they said you can have all this electricity for free. So they've got like no real cost to mine and exclusive access to mining hardware that's specifically made for mining SHA-256 hashes, which leads to like this huge centralization in China. And there's coins that are addressing that, but I don't know what will happen. Yeah, so there's like a bunch of places where you can have centralization. You can have it with miners. You can have it with developers. You can have it with users, what we choose to believe in. There's a bunch of places where you can have centralization. There's actually somebody that wrote a blog post recently about how you measure or quantify centralization in a system. And I think one of the most centralized things in Bitcoin at the moment, he said, was the development team. And I have like no opinion for or against the development team. Yeah, maybe there's like what, 5 or 6 people that contribute the majority of the code to Bitcoin. I'm not sure. So you know more? No, okay. Huh? So more efficient ways to look up your balance in a database. Because you don't really own Bitcoin, it's sort of complicated. Bitcoin is like a series of checks. When 12.5 Bitcoin comes into the ecosystem from mining a block, that's what we call an unspent transaction output, UTXO, and your wallet owns that UTXO. And as people send you money, you accumulate more UTXOs. And then when you use that UTXO, you split it off and send it to somebody else. And then they have a bunch of unspent transaction outputs. And to calculate like your balance and that like you actually own that UTXO, you have to go through the entire history of that UTXO and all the transactions it's been involved with in order to ensure that you are the actual true owner of it. So optimizations around the lookup strategies of UTXOs is like one of the things that they do. They also have a roadmap of all the stuff they want to do. Anybody else? So the question was, is it true they don't know who wrote the initial code? So for those that don't know, this guy went by a moniker of Satoshi Nakamoto, and he like mined the first block, released the white paper explaining how the system works, coded the software and distributed it to people, and has since disappeared. There's like rumors that he's died because he owned a bunch of Bitcoin. And yeah, nobody really knows for sure. I definitely don't know for sure. So the question was, how safe is Bitcoin? It depends how you store it. If you store your money on an exchange, you're probably dumb. Like you really shouldn't do that. You should, because like for example, if I'm a hacker, am I gonna hack an exchange wallet which has hundreds of millions of dollars in it, or am I gonna hack like some dude's wallet that has $1,000 in it? No, of course I'm gonna go after the exchange wallet. And if you keep your money in the exchange's wallet, you're just making yourself a bigger target because you're part of that like $100 million. You can also ensure the security of your coins by making what we call a cold wallet and storing the private key. The private key is essentially a number, but it can be represented by a bunch of words, like 12 randomly generated words, which you can put back together to form your private key, and your private key is what you use to sign transactions. And what you can do is you can put like 4 of the words of your key in one place. You can give 4 to a friend, put 4 in a bank deposit, you know, and then like nobody really has full access to it except for you, or you can just remember it in your head. So like it's vulnerable, but there's like a lot of ways around it. And like the people that I know that have like hundreds of millions of dollars worth of crypto, like a lot of their stuff, they won't even like reveal how they secure it, and they kind of have security through obscurity. So, so, so the question was, can I explain the difference between keeping your money on an exchange versus keeping it in your own wallet or somewhere else? So there's like a few places you can keep crypto. One is in an exchange, obviously, where you bought it for your dollars or pounds or whatever you spend. And then you can also keep it on your phone, like just in a wallet on your phone. Or you can keep it on a desktop wallet. Or you can keep it in what we call a cold wallet, which is where you generate a public address, you send money to that address, and like you make sure that the computer you generate the address with is completely disconnected from the internet. There's no chance that there's a virus on it. You booted it from like a live boot CD, so there's no operating system or anything. And some people even go so far as to like compile their own operating system so that they know there's no malicious code on their computer. So they generate their cold wallet. These people with like hundreds of millions of dollars, by the way. Like I wouldn't go through all that for mine. I'm not that rich. So then you get this wallet and this public and private key. You translate that private key into like 12 different words or whatever, and then you separate it out, and that's like a lot more secure. And you definitely want to have a wallet where you keep control of your private key. On an exchange, you don't know what your private key is. So you get real no say so on like if there's a chain split and it's on an exchange that just doesn't support the split, you just don't get that money.
So how do you send money from an exchange to
Yeah, so the question was, how do you withdraw money from the exchange to your own wallet or cold wallet or hardware wallet or whatever? Yeah, on most exchanges, there's just an option. You click withdraw. You pay a 0.001 Bitcoin fee, which is like $4 or something, and you can move it to your own wallet. Generally takes like 15, 20 minutes for it to be on your wallet, not in the exchange anymore. Yeah. You can generate a public key, I believe, somebody correct me if I'm wrong, without being connected to the network. It just has to be like, you know how you generate, so you're a programmer, right? So you know how you can like generate a private and a public key for stuff like SSL? As long as you control the private key, then any funds sent to that public address you can control, even if that public address isn't necessarily on the network yet, because you have the private key that corresponds to that account number, essentially. I think, so the question was, there's a lot of places to store your Bitcoin. What are each's pluses and negatives for storing it there? Um, I, I think it always comes down to a trade-off between security and convenience. And it depends on how long you want to hold your coin for and like how often you want to access it. So if you want to use it all the time and you're day trading, you're going to keep it on an exchange, right? Because obviously, otherwise you're going to have to pay all these fees to keep transferring it in and out of the exchange. If you want to have it so you can kind of like spend it on a day-to-day basis, you can have it on a wallet on your phone. There's one called Jax, there's one called Coinomi, there's one called from blockchain.it. There's a bunch of options to choose from. And then it's as secure as your phone is, I guess. If somebody gets access to your phone and gets access to your PIN and then like another PIN that you put in the account and maybe a password, then they can use your money. Or if you have it complete, and then if the wallet gets hacked, for example, they might be able to get your funds. But if you like, the safest way is to have like a hardware wallet, like a Trezor or Ledger or whatever they're called, or to have a cold wallet that you generate yourself. And the trade-off is, the con of that is it's a lot harder to get to your money, but you know it's more secure. Anybody else? Cool. Thank you very much, guys. I appreciate it. I feel really weird having, I feel so powerful. Yeah, next week, same time, same place. Yeah.
Thanks, everyone. That was great, Jonathan. Thank you.